For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
All right, let's do it. What do you say? What is this? Oh, yeah, Managing Your Financial Future. It is your podcast. It's our podcast. It's everybody's podcast. And we're happy to have you back with us once again. I am Johnny Dean, your podcast host, here with Professor Rick Plum, certified financial planner professional and accredited wealth management advisor. And today's your birthday. Now, the air date, of course, isn't your birthday, but the recording date is your birthday. So I'll just say happy birthday to you.
Thank you. Thank you.
They're doing a nice big lunch in your honor. Is this what I'm told? So I
don't know how big it is, but they're getting me lunch, and hopefully that means getting for the office.
Well, this is a milestone birthday for you, and I won't.
21 is a big birthday, right?
I won't say which one it is, but. Your Medicare
well, I do
eligible.
get an extra standard deduction this year.
There you go. I was hoping you'd say that. Man, oh man. I'm not that far behind you, but I've still got a few years to go. Well, happy birthday to Professor Plum.
Thank you.
Good to have you, and thanks for doing the podcast on your actual birthday. You're going to get a free lunch from everybody there. I think they're just ordering pizza. But there's nothing wrong with that because
good pizza, though.
That's right. Everybody can share. So, what are we talking about today? Well, here we go. We're continuing now. This is actually the last, if I counted correctly, I believe this is the last episode of the season, whatever the season means. And that means, I think, 12 episodes. So we're going to take a couple of weeks after this and maybe replay an episode or two, some of the good stuff from before. But I thought I would conclude this season, and I'll put it in quotes, with the 5 things, one more 5 things. And this has to do with income taxes, or taxes in general, I should say. 5 things you didn't know about taxes. And again, I'm making assumptions that you folks listening didn't know. If you are regular listeners to this podcast, you've probably heard some, if not all of these at one point. But it can be complicated, and it's easy to forget. So I wanted to go over these with you. Professor, I told you at the end of the last episode that I wasn't going to tell you exactly what we were going to talk about, but I cheated, and I did. I gave you the topic yesterday, and I don't think you
But you're also assuming I read it.
Well, I know that. I didn't really give you the question so much, but I gave you the topic, and I don't think you can be fooled on any of this stuff, which is a good thing to that's a good quality to have in a financial advisor. So I want to start off with this right away. This one, so 5 things. The first thing that came up when I did this research, and it's, again, this is based on the questions we've been getting since 2009, the emails, and I put these into groups. I told you in a previous episode, this is what I did. So the questions that came up about taxes. Now, the first one I'm going to leave off. Because it was the fact that you can be taxed on your Social Security benefits. We covered that at some point. I think when we were
relatively recently.
Yeah, I think it was when we did the 5 things you didn't know about Social Security. Anyway, we've talked about that probably enough. So I'm not going to include that in the 5 things. We're going to go through the next, I guess that would be 6 total. But since we're not going to talk about that, the first thing that you didn't know about taxes, and I love this one because many people don't know this, is that your tax bracket isn't your tax rate. If you're in the 24% bracket, some people think that means all of your income, 24% of all your income goes to taxes. Professor, that's just not the case, is it?
No, it's not. We do have a progressive tax system, and we also have deductions. And so there are lots of terms, and the terminology gets a little, technical. I mean, there's adjusted gross income. There's taxable income. They're not the same things. And adjusted gross income, by its very title, is not your total income. It's adjusted. It's got some movement to it. And then, so understanding the terminology, and a lot of people will look and say, well, I made $100,000 last year. And if you look it up online, and you look for the tax brackets, if you're looking for the federal tax brackets, $100,000 for a married filing a joint return says that I am in the 22% income tax bracket. So I've had people say, well, if that means I'm paying $22,000 on $100,000, no, that's not the case, because we do have a progressive tax bracket, and your total income is not your taxable income. So understanding how this works can be very important. Realize that if my total income is $100,000, there are certain adjustments that I get to make to that before it even goes on the tax return. My group health insurance, things of that nature, fringe benefits at the plan, my 401k, traditional 401k contributions, all come off the top before I get to the adjusted gross income. And then from the adjusted gross income, we get to take a big deduction called the standard deduction. For a married couple, it's just shy of $20,000 or $30,000. So even if I'm not, if I don't have any fringe benefits and I'm not putting money in a 401k, my $100,000 of income doesn't go on the tax return as $100,000. It goes in. It starts at 100 and it gets reduced by almost 30,000. So my taxable income is $70,000. I don't pay any tax on the first, call it 30,000. It's 29.2 for this year, by the way. And then over and above that, once I get to that taxable income column, okay, if I look at it, it says I'm in the 12% bracket at $70,000, but I don't pay 12% on all 70. I pay 10% on the first 23,000 and change, and 12% on the rest. Now, everything's progressive. The higher I go on the income scale, on the taxable income scale, the higher my marginal. Marginal is what is the tax on the last dollar that I earned, or what I should say, what is the tax on the last dollar that showed up on the tax return? And but I don't ever go back and lose out on that 12% bracket, that's 10% bracket. I just get to pay tax at a higher bracket on the excess, the new money that's over and above the 12% bracket. So it all averages out. And that's what people talk about, the average tax bracket. My average bracket may be 10 or 11%, but if I earned an extra $10,000, I'm paying 22 cents on that dollar. So it's all understanding this. It helps you understand how you can manage your taxes. If I can take a deduction on something, if I make a deductible 401k or I'm able to take a deductible IRA contribution, that doesn't save money at the average bracket. It comes off the top, and it's the last dollars in that get to be deducted off. So I get to take it at the marginal level. And so understanding that tells me what it's going to benefit me or cost me to either deduct or show additional income on my tax return.
Somebody could
now,
be
that's
in the
basics, because it gets a lot more wonky than that too when you talk about what you didn't want to talk about, the taxability of my Social Security benefits, because then if I'm in the 12% bracket, I may not be actually paying 12% on the next dollar I show, because for every dollar I show, some of my Social Security becomes taxable at 12%. And so it gets really wonky in that sense.
Well, we will delve into that a little bit later on in the episode here. But yes.
But it is nice to know what your average bracket is. But again, I've seen average calculated different ways. Am I paying, what is my average bracket on the taxable income? What is my average bracket on the adjusted gross income? What is my average bracket on my entire income? Those are all different numbers. And how do you want to look at it? What am I trying to say with that terminology of average? What I would suggest is that everybody look at their tax return and see the actual dollar amount that says this is your total tax, not your refund, not what you pay when you file a return. This is my total tax, just to see so you can see what you're actually paying in taxes throughout the year, what you owe them.
So it'll really make you mad.
Yeah, it has that tendency when you say, when you think, okay, well, I don't really know what I pay in taxes, and you think, I paid 10 grand, I paid 20 grand, I paid X amount of dollars. Holy cow, I paid a lot in taxes, because you don't notice it especially when you're working and you have money withheld from your check. You see your check that's in the bank, but you rarely look at what the total check was before the withdrawals or withholdings. And then you maybe you owe $1,000 when you file your return, or you get $1,000 tax refund. That wasn't that bad. But then when you look at the real number, you say, I paid 20, I paid 50, I paid what? Oh my gosh, this is not.
Well, so really, I mean, somebody can be in to sum up what you're saying is, say the 22 or let's say the 24% bracket, whatever, but they can have what would be the average or an effective tax rate,
probably around 10 or 11
to 11, 12%, something like that. So it's something. The importance of that, it's hard to overstate, because understanding how this works gives you, as you said, some leverage when you're trying to manage your taxes. So that's the first thing. Your tax bracket is not your tax rate. capital gains. This is the second thing that you didn't know about your taxes. Capital gains can affect more than just capital gains taxes. Now, we have ordinary income taxes. You have capital gains taxes. There are different things. Long-term capital gains are taxed at favorable rates, I'd say, but they can also trigger other taxes, as you mentioned, like making more of your Social Security taxable or causing these Medicare surcharges.
Right. And so you may have Social Security and you have IRA or pension income, but the combination of those two doesn't create much of a tax when you look at what's going on. And then all of a sudden you have some capital gains, whether it's a capital gain distribution from a mutual fund or you sold something and it created a capital gain. And all of a sudden you say, well, wait a minute. If I look at the brackets for a married filing a joint return, as long as my income, my taxable income, including the capital gain, does not go over $95,000, $94,050. Okay, I'm rounding. That capital gain should be in the 0% income tax bracket. But because I showed that $10,000 capital gain, I'm paying taxes all of a sudden that I wasn't paying before. How could that happen? Well, it's because it affected the tax on your Social Security. So you're technically not paying a capital gains tax, but you're paying tax on $8,500 of Social Security that wasn't taxable before. So you're paying some additional tax. But it's, wait a minute, it's only because of the capital gain. I was already getting the Social Security, and all of a sudden this year I had the capital gain. So isn't that a tax on the capital gain? Depends on how you want to look at it. Technically, no. Reality is you got to pay the tax. So capital gains become part of your adjusted gross income. Your adjusted gross income is used, or at least the majority of it is used to calculate how much of your Social Security is taxable. It's used to determine how much of your, whether or not you have to pay IRMA, income-related monthly adjustment amount, on your Medicare premiums. It's used to determine a lot of other things, one of them being how much of your medical expenses in any given year you can deduct, because medical expenses are potentially an itemized deduction, but only the amount that exceeds 7.5% of your adjusted gross income. The higher your adjusted gross income goes, the higher that threshold is to be able to deduct those medical expenses.
So if you have what might be considered a low income year, at least that's, maybe from work or whatever, you've cut back or something like that. But if you happen to have a fairly large gain, 30, 40, 50,000 or even more, depending on what you did, that gain can still come back to bite you if you don't know your entire tax picture.
It can still trigger other taxes that may come into play, where it's, like I said, it's technically not a tax on the gain, but because the gain was part of your adjusted gross income, it subjected other things to taxes that you weren't paying tax on before at ordinary income rates.
So if you're collecting Social Security benefits, or you're on Medicare or any of that stuff, and you do happen to have a large capital gain, this happens quite a bit when people sell homes. And
vacation homes, rental homes. It happens from time to time with primary residences, but with that $500,000 exclusion, a lot of people get to sell their primary residence without a tax.
Not me.
It's for the people that have more than $500,000 a gain. Oh, wah, John. We're gonna cry a big river because you had to pay a tax when you sold your house. Oh darn, you had too much gain. Yeah.
It was still not fun writing that check. I could think of so many things I could have done with that six figures. But anyway, but what it does. But if you are on Medicare and you do sell a vacation property, or you have a big gain, and that's not unheard of, as I said, I sold my primary residence, but there are people who retired. They've been in their home for 45 years, and if they're in a high gain state like California or maybe New York or somewhere where they bought a long time ago, that can have an effect on that. And
2 years later, if you are on Medicare, you'd get the privilege of paying a little bit higher or a lot higher, depending upon how high you go on that taxable income, your adjusted gross income. You get to pay more for your Medicare. It affects the net investment income tax. If your adjusted gross income goes over certain thresholds, 200,000 single, 250 married, and you have investment income, capital gain, interest, dividends, things of that nature, you get to pay an additional 3.8% tax on that investment income, to the extent that the AGI, the adjusted gross income, is over 250. Now, you may be able to deduct some things, and so your taxable income is under 250, but they don't look at taxable. They look at adjusted gross income.
Now you threw in the 2-year thing, and I just so people know
that's for IRMA.
That's for IRMA. But what happens is they don't see that gain right away. If you have a gain in 2025 and you file your tax return in 2026, they're not going to really see it till like 2027 when they.
Well, they don't see it till late in 2026 because they do look. Because you're filing your tax return in, technically you're normally doing it early 2026. You're filing your 2025 tax return in early 26. Late in 26, they match up your tax return to Medicare things, and they say, hey, your 25 return was over the threshold for income-related monthly adjustment amount, and they're looking at this in October-ish of 26, and they say, okay, so because it was over the threshold for 2027 next year, we're going to increase your Medicare premium. And they do it every year. So if your income's high for 1 year, then you will end up paying the higher Medicare premium for 1 year. But then when the next year, so when you file your 27 return or your 26 return in 27, when it matches up, they'll say, oh, you weren't over the limit? Okay, so your next year's, you don't have an IRMA for the next year.
Well, this is why it catches people off guard, because they may have forgotten. Or I was 2 years ago when I had that gain. Why didn't they charge me right away? Because they had to reconcile the return. So just to understand how capital gains can affect more than just capital gains taxes, it's important to keep in mind.
For people that have a life-changing event like retirement, marriage, divorce, death, a life-changing event, you can choose to not look back 2 years. You can say, well, wait a minute, I retired last year. Sure, in 2025, my income was $1 million, if only. Yeah. But I retired, and now my income's only 150. And so I want to look at what I'm making this year. If you had a life-changing event, you can base your income on this year's income, and they will take your word for it until they match it up, and you better be right. Because if you lied, they're going to come back and ask you for the money. They're not going to ask, they're just going to take it.
They're going to demand it, yeah. So, all right, so just be careful of that. So here's another thing you didn't know, the third thing you may not have known about taxes. Tax-free income still counts for other calculations, or it can. And what I'm referring to here is specifically is the more common one, I think, is like municipal bond income, where it's federally tax free, but it counts toward income thresholds for things like Medicare premium, Social Security taxation. So let's talk about that for just a moment.
I mean, municipal bond interest, tax-free interest. Now, this does not include qualified Roth distributions, but this is interest that's tax-free for whatever reason. Interest that you are not putting on your tax return. You earned it, but you didn't put it on your tax return. It does count as part of your modified adjusted gross income. It's one thing to have an adjusted gross income, and then so you're taking your whole income and you're adjusting it to get your adjusted gross income, but then they're taking the adjusted gross income and adjusting it again to create a modified adjusted gross income for different things and how they do it. So IRMA includes tax-free municipal bond interest. A lot of things, your ability to do things, it doesn't directly affect your tax bracket, but it affects your ability to do other things, make deductible IRA contributions, do this, do that. It affects a lot of things. Now, right now, unless you're in the very, very high tax brackets, most people are not using munis. There's just, you got to be in the higher reaches. You got to be in the 35, 37% bracket to really make the spread between the interest rate on a muni and the interest rate on a CD or corporate bond pencil out to where I keep more in my pocket without paying taxes than even after paying taxes. I mean, right now, a treasury is, or CDs are in the 4.3, 4.4 range maybe, and a muni's in the 2.4 range, give or take, for the interest. I can pay a lot, almost 50% in taxes, and still end up with more money with the corporate than I can with the muni. So I bet, you do have to look at it that way. But municipal bond interest affects other things.
Yeah, and so tax-free may not be entirely tax-free, and I think it's something that if you're going to use things like municipal bonds, I think you need to decide if it's really worth it. Go over that with your advisor, anyway.
On many levels, yes.
Yeah, so just keep that in mind. That's another big surprise to somebody.
And then look at the state that's issuing the bond and say, okay, they are in deep doo-doo. Do I really want to trust my money with them to get paid back?
Well, that's the other thing you got to look at too. I don't think. As a state,
we haven't had any defaults in the. I remember Stockton, California, had an issue on their bonds at one point. Some other cities. But it happens.
It happens with cities. I don't know that it happens so much with certain states. But anyway.
But municipals include cities and other things.
Yeah, they do. They do. So just be careful there. Okay, so far we've got 3 of them. Your tax bracket is not your tax rate, all right, because you have the marginal rate and you have kind of the effective or the average rate. The second one is capital gains taxes can affect more than just capital gains taxes. And the third one we just talked about, tax-free income can still count for other calculations, and specifically munis in that sense. The fourth thing you probably didn't know about taxes was that you may pay taxes on money that you never actually received. Now, I don't know if they call this phantom income or what, but it's income that can show up on your tax return even though you didn't see any cash. And I guess what I'm talking about here, something we've mentioned before, mutual funds, capital gains distributions toward the end of the year. I think K1 income from partnerships and stuff like that.
Right. And did you know, though, that there is a bill that's been introduced again, it's not the first time, to make capital gain distributions that are reinvested not taxable? Because right now, if I have a mutual fund that has a capital gain through the year, so the mutual fund buys and sells investments throughout the year. And if they're doing it right, hopefully, they are creating gain when they sell those assets. They buy a stock for X and they sell it for 2X, whatever. So there's a gain. Any gain that's realized in a mutual fund has to be paid out to the shareholder at the end of the year. And so even though you didn't sell the mutual fund internally bought and sold things. If the net effect of the year's operations was a positive gain, they will issue that as a capital gain distribution at the end of the year. And you get to pay taxes on that capital gain distribution. Now, a lot of times, people never see that capital gain distribution because they reinvest it. They have their investment set up so that any interest, dividends, and capital gains that are issued get automatically reinvested back into the fund, which is a great way to build an overall investment over time. Mm-hmm. But if it's not in an IRA, if it's just in your personal name, that distribution, that interest that was technically paid out to you, even though it was reinvested, is a taxable event to you at the end of the year. And so, yes, I may have it may be a bond fund that's paying interest, but I'm reinvesting that interest. It may be a dividend fund. It may be maybe it's a capital gain. I get to pay taxes, even though I never saw the money. I had it reinvested. And people are, well, if I didn't see it and I didn't receive it, how could it be taxable? Technically, you have the option. Not technically, you have the option to have that money sent to you in cash into your bank account, into your pocket. And then what you're doing is just choosing, instead of you then turning around and writing a check back to the investment company that's doing it, you just say, just reinvest it as if you had sent it to me and as if I had sent it back to you to reinvest. They just make it really easy, which is probably the best thing for you anyway. And but it's still taxable to you.
Yeah,
unless they can pass this law, which I don't think is going to pass yet.
Have they introduced legislation like that before?
Yes. I don't remember the first one. I know it was introduced in 2005. Didn't really go that far. Well, I don't know if it's been reintroduced how many times since then, but it's being pushed back again now, or pushed back into the site now. We'll see. I mean, so far it has not gained significant traction, but then the idea, this is going back a little bit, to make Social Security more fair and not have a GPO on WEP had been introduced many times and never got any traction. And all of a sudden, towards the end of last year, it gained a lot of traction and passed. January 5th of this year. So every once in a while, things kind of sit out there, just kind of tepid, and then all of a sudden, boom, there's a movement that says we're going to pass this.
I suspect though that the net benefit to people who with mutual funds is not really going to. They're not going to see any net benefit if I'm thinking of this correctly, because even though you pay capital gains taxes on money you didn't get, what that does is it raises your tax
basis
on that. So ultimately, when you sell the whole thing or whatever, you take distribution of it, your basis is a little higher based on every year these gains.
And for the average investor, that could be a problem because, if you take somebody who's making $100,000 that gets a capital gain distribution, that capital gain distribution is treated as a long-term capital gain. It's not taxable, or it has a 0% tax bracket because it's only $10,000, $15,000, maybe $1,000, $2,000, $4,000, $5,000. But you defer that for 15, 20, 30 years, and then you get a big capital gain distribution because you sell the asset, or in somewhere down the line, and you have a $100,000 gain. Now it's going to be taxable. That's going to leave a mark. So you think Congress is doing this to benefit you? Nope, they're doing it to benefit themselves. Am I being too cynical? I'm sorry.
I'll leave that to people who want to interpret the way it is. But honestly, and I hadn't thought of that angle. You're right. That could turn into a rather large gain, especially over a long period of time. So just keep in mind, you might be paying taxes on money that you never actually received.
And limited partnerships, your businesses. You may not be taking money out of your business, but that didn't mean it didn't have a potential profit that you had to pay tax on. So that. There's a difference when it comes to business operations, ones that may be passed through either self-employment, S-Corp, LLC, or K-1 distribution from an S-Corp, things of that nature. There's a difference between cash flow and taxability because some things are deductible all up front, even though you may be paying for it over time. And so let's say I buy a truck and I have a 6-year loan on it, and I deduct it all in the first year. So I take an $80,000 deduction the first year, but it only cost me, $20,000 out of pocket that year for the payments. Well, my income is really low that year because I had a nice, big, fat, juicy $80,000 deduction. The next year, I don't have a deduction, but I had a payment of $20,000, so I don't have that money in the. It's a game, and so there's a difference, and it is interesting to track.
Well, and for many business owners, there's another surprise that they get. So
right, and so as a business owner, you got to get control of what's happening, and so you know what's going on.
And speaking of control, this is the last one that you didn't know about your taxes. Number 5, you may have more control over your taxes in your in retirement if you plan ahead. Now, I think most people assume that taxes are a fact of life, but this is where tax management comes in, and I think especially in retirement. It seems to me, and you can disagree because you're the advisor, but it seems to me that when you're retired, you've got a lot more control over the taxes, potentially a lot more control over the taxes that you're paying, as opposed to when you're working. When you know how much you're going to make, you're making this much, and there's not much you can do about it. Is that a fair assessment?
For many people, you do have more control than you think. For some people, you may not have any control. It may be just what it is. So it depends on what's happening in your life, where you are, and where your income is coming from. And have you done anything leading up to retirement where you have different sources, different tax sources of money? Money in personal name that's taxable if you earn something, whether you spend it or not. Money in an IRA that's tax deferred until you pull the money out and it's taxable. Money in a Roth IRA that is technically tax deferred also, but potentially tax free when you pull it out. And so having different sources of money, and let's say that you're more of the typical retiree, that when you retire, 95% of your money is in a deferred traditional type IRA, you still may have some control based on when you start taking your Social Security or don't, when you start taking draws, how much you're drawing, and where you are on the tax brackets. Going back to the very first part, knowing your brackets, where are you at? Do you have room to accelerate distributions and stay in the same bracket you're in today, and that will help you in the future or help your spouse as a surviving spouse in the future, or if you're so inclined to help your kids in the future, your legacy to your non-charitable beneficiaries.
This is where we've talked about things like blending buckets, and I think this is where a big part of the bucket strategy really shines, and it shows how it's not just about. There's a couple of episodes back we talked about how buckets is not just a cash distribution system. I mean, this allows you when you're blending the buckets, and you're saying, well, I can take more out of my taxable this year, or maybe I need to take more out of my personal. Maybe I can spend some Roth money. Whatever it is. Having the different sources of income can help you. And I think this is where people can certainly have, with the right advice, I think, because it can be complicated, but you can have
very complicated.
Yeah, and you can have a certain amount of control over your taxes. I don't say this a lot, but this is one of those things I really don't think you should do on your own unless you are really, really on top of it.
Well, managing your taxes requires first understanding your taxes. And that's just unfortunately something that a lot of people don't want to look at. They don't even look at their tax return. They turn it all over to a preparer, and the preparer tells them what to do with it. And they just, whatever, they grumble about it. But they don't ever look at the return to find out what it is that's creating the issue, or is there room on the tax return to benefit me in some way? Maybe not today, but in the future. What can I be doing to manage it? But to manage it, I have to understand it. To understand it means I have to look at numbers. A lot of people don't like looking at numbers. They have to look at the fact that there's a dollar sign in front of that number, which makes people very emotional about that math that they don't want to know in the first place. And then they throw in the word taxes, which makes the emotion right off the bat a negative emotion, and it just ticks them off. It's like
it turns it into rage, is what it does. In some
cases, yeah.
Yeah, in some cases.
It's unfortunate that it tends to make people shut down and not pay attention and just get mad into an inactive state.
Well, this is
fine to get mad, but do something about it.
And this is with the tax preparer and all that. It's a case of garbage in, garbage out, and in the sense that the CPA or whoever's doing your taxes is just taking the numbers that you give them and the actions that you did, and they're just turning that into putting the numbers on the form, and this is what you're going to have to pay. And this is where the advice, the value, I think, of an advisor, an effective advisor, really comes through. Because if you know, like you do, and this is why we're talking about this today, and we're talking about managing your financial future, taxes can come in the future. And this is an important thing to understand. And if you don't understand it, and you don't have to, you just have an advisor who does understand this, and you have to know what to look out for. And this is another reason why I'm kind of doing these 5 things you didn't know, and the importance of talking about taxes. So, Professor, if there's a way to control your taxes, you could even potentially avoid the income-related monthly adjustment amount IRMA surcharges.
And IRMA is progressive as well. So even though you may not be able to avoid all the IRMA charges, you may be able to stay out of the higher reaches of IRMA, because IRMA scaled up. I mean, at first, increase is like $75, but then it's like $100 the next one, $100 the next. Yeah. It could go up to like $400 more, $500 more
per month.
But it's scaled up, so you don't automatically trip into that high bracket, because not everybody's making $750,000.
Yeah.
Oh darn! But it starts in the $200,000 range, and it creeps its way. It jumps its way up.
It jumps.
Creep.
It jumps right out at you, is what it does, like a thief in the night, is how it is. So these are the things that you need to really be aware of. Just to recap what we've talked about. First thing you didn't know, maybe your tax bracket is not your tax rate. Just to recap this. Capital gains taxes, they affect more than just capital gains. Tax-free income, we said, it still counts for other calculations in many cases. You might pay taxes on money you never actually received. And the last one, the most important one, I think, in this case, in our case, is that you have more control over your taxes in retirement, potentially, if you know how to plan and you have the proper structure. So, taxes, we talk about that a lot on this podcast, and I try not to overdo it, because taxes could just, people, eyes glaze over, But
it's a big part of your financial picture.
Exactly.
And it's a big part of your financial picture that you may, not always, but may have some control over.
Because it's just money. It's just money that's gone. It doesn't do anything. It's just gone. And if there's a way that you can keep that legally, and write the absolute minimum and pay the absolute minimum amount of taxes that you owe, and everybody has a number that is the minimum that they owe, so much the better. If you overpay in taxes, nobody's going to write back to you and say, hey, you should have done it this way. Here's a check back. It doesn't work that way. So you got to be proactive in your planning. And that's what the folks at Lucia Capital Group do on a regular basis. I would say every day, pretty much. 800-644-1150 if you'd like to have your tax situation looked at. Not just about, it's about planning, but it's really about planning over the long term. It's about tax management, not necessarily short-term tax minimization. Maybe it is about short-term minimization. But just understand that management extends over a period of years, and it becomes especially important as you retire and you get close to that dreaded required minimum distribution age. which can really throw a wrench into things if you haven't planned properly. So talk to them at Lucia Capital Group, 800-644-1150. Go online, luciacap.com, luciacap.com. You'll find a lot of this information right there at luciacap.com. Again, don't forget to look for our guides. We have the guides. I think the Social Security guide has been updated, I do believe, Professor Plum.
I don't know. I put in my 2 cents, and I don't know what happened after that.
I believe it has. It was going through just the compliance stuff. But I think by now, by the time this airs, check it out. Just type in Social Security, and you'll get the Social Security guide there at luciacap.com. But we also have an income guide. We have a retirement guide. We have a bucket strategy guide and all that stuff. And taxes play a role in this as well. So check it out at luciacap.com. It's all free to download. Great information there. Don't forget to subscribe to this podcast. Remind you this every single time. Go to Apple Podcasts or Spotify and make sure that you listen to every single episode. Have it automatically downloaded to whatever device you happen to be listening on, and learn something. I mean that in a gentle, soft way. Learn something. I learned something. I've been learning stuff for over 3 decades now. And I think I'm better off for it. So just make sure you listen to every podcast. Professor Plum, I'm going to just wish you happy birthday one more time. I'm going to let you get to your lunch, which I think is going to start here shortly. They're going to have pizza for you and anything else, or is it just the pizza party?
I don't know. They said, "What do you want for lunch?" I said, "Nothing. Don't worry about it. Come on, you got to say something." It's like first thing came to my mind was pizza. Good pizza.
Well, that's one thing. It doesn't matter if you're 7 years old or 77 years old. You're not 77, but if you're 7 or 77, pizza parties work. Okay, so
it works for me.
You better believe it. Thank you so much. I appreciate you being here for Professor Rick Plum, certified financial planner professional and accredited wealth management advisor. I am your podcast host, Johnny Dean. Managing your financial future. Thanks for listening. We'll talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. There's no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. Before investing, carefully consider a mutual fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Municipal bond interest may be subject to the alternative minimum tax. It is important to keep in mind that investments in fixed income products are subject to liquidity, interest rate, financial inflation risk, and special tax liabilities. Interest may be subject to the alternative minimum tax. Treasury securities are backed by the full faith and credit of the U.S. government but are subject to inflation risk. Alternative investments may not be suitable for all investors and should be considered as an investment for the risk capital portion of the investor's portfolio. The strategies employed in the management of alternative investments may accelerate the velocity of potential losses. CDs are FDIC insured up to $250,000 per deposit or per insured bank for each account ownership category. The information provided is based on current laws which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor, and member FINRA SIPC. LPL Financial Insurance License Number 0518721. LPLIA Insurance License Number 0B91442.